Hello everyone to my Economics. My name is Oluwole Godwin. Welcome back to our class on national income accounts, or accounting as the case may be. In the previous class we talked about the income approach and we highlighted the basic elements or the broad elements of GDP where we try to use the income approach to obtaining it. So in this class I'll be talking about, we shall be expatiating on the expenditure approach to measuring GDP. When we introduced the expenditure approach, I think in the very first class, when we were talking about national income accounting, I was trying to say in that class that expenditure approach is all about calculating the aggregate spending on the final goods and services produced in an economy at a given period of time. Now, these goods may be produced in an economy and they may not be produced in the economy. Okay, because we will get to that soon. You are going to see that soon. So that is what we basically mean. Expenditure approach is the summation of all the aggregates. We call it aggregate spending, okay, of every economic agent in an economy on the currently produced final goods and services. So they need to be, the goods and services should be currently produced and they must be in their final form. Okay. Now we basically have 4 macroeconomic agents. First, we have the household, and what the household does, or what economics assume that the household does, is to consume. So households consume, they go into the goods markets to buy goods and services. Then number 2, we have the firms. The firms invest. They are the ones that produce the goods and services. They are the ones that hire the activities of laborers and all of that, and combine factors of production to produce something tangible that could be bought and sold in the goods market. So they invest. They are the ones that engage in increasing the capital stock of an economy. Now, number 3, we have the government. So what economics assume that the government does is to spend as well, okay, to spend. But we know that in the real world scenario, real world situation, the government doesn't just spend. And even from the class we've been having so far, we're talking about the current the surpluses of government enterprises. So we discover that government sometimes invest, but then for simplicity, we assume that the private sector does all of the investment, that the government only buys final goods and services. And number 4, we have the rest of the world. So the rest of the world is talking about the transaction that occurs between foreign countries and the domestic country. Okay, so these are the 4 basic macroeconomic agents that we have in an economy. Whatever spending they do, we have to sum up all of their spendings in order to arrive at the GDP using the spending approach or the expenditure approach. Spending is the same thing as expenditure. Okay. So what we just do is, I have already denoted this. So households consume. So we have C for consumption. Okay, we basically call it aggregate consumption, and it is the largest, okay, component of the GDP, the largest component of the GDP, and that shouldn't be worrisome, simply because at the end of the day, everyone in an economy belongs to an household. Okay, belongs to the house at the end of the day. So the government, the people in the government, people in firms, household themselves. At the end of this, everybody has a home. Okay, everybody belongs somewhere. Okay, so at the end of this, so by the time we bring up what people are spending from their respective households, at the end of the day, it becomes bigger than any of the other components of GDP. Okay, so we have that households consume. So we have aggregate consumption, which is C. Firms invest, we have gross domestic private investment, okay, so which we call I. Then the government spend, we assume that the government, so that's just government spending, letter G, which is G, and then the rest of the world, which involves in international trade, import and export, which it denotes as NX. Okay, so trade in import and export, NX. Now by the time we open it, NX is the same thing as export, X is export minus import, M is used to denote import. It depends on the textbook that you are using. But X generally, I think in the textbooks I've sought and I've found that in them export is usually denoted with X. But import might be IM. It depends on the book that you're using. It could be M, it could be anything. But what is more important is that we denote what they are representing, like we state what they are representing. All right. From there, we then go into the components of this component. Okay, well, let me say elements of the component of GDP when we use the expenditure approach. Okay, by the time we talk about aggregate consumption, which is the biggest component of the GDP, so households spend on durable and non-durable consumer goods. So when we're talking about durable goods are goods that are used over time. They are not used up at once. So we use them continuously. We have refrigerators, freezers, air conditioners, television sets, and so on and so forth. Then we also have non-durable consumer goods. Our seasoning that we use, it seems like food. Okay, the seasoning we use for once and for all. They are done with many of them. We have foods that we eat, our food, our many things. You can mention a few of them over there. And we also spend on services. The service that you are enjoying now. Although you may not be spending directly, but you could be using data. Of course, you'll be using data to check it unless someone sends this video to you, maybe through Zenda or any other non-internet means. Teaching, you make your hair. Okay, you go to make your hair, whether you're a man or you're a woman, it doesn't matter as long as you make your hair. Someone sews your clothes, a lot of things, transportation from one place to another. Those are services that we pay for as households, as individuals. So everything, when we sum them up, they constitute the aggregate consumption, which is C. Now let's move into I, which is the gross domestic private investment. It is the most volatile, so we should note that. And volatile means it changes, so it depends. It is the one that changes more quickly when we look at every of the components of the GDP using the expenditure approach. So what are its own elements? You have the business fixed investment, and this one is divided into two. So this fixed investment is just talking about investment in structures, equipment, and so on and so forth. Now these structures are basically non-residential. The structures are we have structures that include offices, structures that include factories, and so on and so forth. So those ones are under the non-residential investment. Then we also have equipment and software. Of course, I don't think I need to expatiate on that. Equipment, that's the machines that they use, the computers that I use, and even the softwares on them. Okay, so businesses spend on those. Okay, you are probably seeing this with a software that someone developed somewhere. That doesn't mean you're a firm, I'm just saying. Now, B, you have residential investment. It might be funny that why should residential investment? Residential investment is all about investment in houses, apartments, places people live in. Okay, it doesn't matter the type of house it is. Why is it not under consumption? Why is it not under household consumption? So it is not under household consumption because houses and apartments are considered to be something like capital goods. Okay, because this is because they provide housing services over time. So that's why we classify them as a residential investment under investment in the investment component. There's also inventory investment, so we have to be careful here. So inventory is just the stock of raw materials, processed goods, and final goods that have not been, and final goods that were not sold in a given year. So once again, inventory is a stock of raw materials, processed goods that are still in their process of production, and final goods that were not sold in a given year. So inventory is a stock of everything. So why do we not consider them under other type of goods, or maybe intermediate goods? We can't say they're intermediate because inventory is seen as something that is an increase, that represents an increase in the capital stock of a country. Okay, so you do not really have to bother yourself with what about the cars that have been produced and not sold. Are they increasing the capital stock as well? Of course, are they not? All right, so we just have all of those considered under inventory investments. If they are raw materials, and I think I was talking about that in one of our videos, that we're talking about intermediate goods have to be used up in a given year. There are goods that are used to produce other goods and are used up in a given year, but then such goods may become inventory if they are not used up in that year. So if you have a raw material, or if you have a good in the process of production that wasn't used up in a particular, it's an addition to the capital stock of the economy. So it's classified under investment instead of intermediate goods. So I would like you to note that. Then number 3, we have the government spending. Of course, government spends. So government spends at all levels: federal level, local level, which is local government level, and the state level. The government generally spends on defense and non-defense, items. So the guns, finance, the police force, the navy, and so on and so forth. Which mostly occurs at the federal level. But there are countries that have state police, and there are countries advocating for state police, which the states would be in charge of. Okay, so we could have defense spending also at the state level, and then we have other spendings at the local level, the building of schools, clinics, all of those structures that the spendings on all of those things that bring about immediate relief to people and so on and so forth. You know, the schools, primary schools and secondary schools, clinics. You know, you want to do a little, you know, in developing countries like ours, maybe a little grading of the road. It's not a tarred road, a little grading of the road before the federal government then comes and, you know, intervenes and does the real thing. So those are spendings that the local government engages in. So number 4, we have the net exports, which is talking about what the rest of the world does. There is no big explanation concerning this. It's just divided into imports and exports. Now, when we talk about imports, those are goods and services that are brought into a country from other places, and exports are goods and services that are sold out of a country to other places. So net exports, then the net of it, which is exports. The export is the one that brings the money in, minus imports, the one that takes the money out, gives us the net export. So that's how we have GDP plus C plus I plus G plus, this is the net export, export minus import. So this is what the expenditure approach is all about. And let me call this an introduction to it, because it could become complex than this, and in fact it is complex than this. It depends on the level that you have, the class that you have, what you're actually seeking. Consumption can be broken down into autonomous consumption, induced consumption. Investment can be broken down into those that, you know, investment due to your interest rates, investment not due to interest rates, autonomous, and so on. Government spending too could become a little bit complicated. Then exports could be a function of exchange rates, all of those stuff. So it depends. So the more we go, the more we get to see how all of these things could be expanded. You know, talk about the multiplier, we talk about stabilizers, we talk about a lot of things. All in all, we are going to make those videos very, very simple for you to comprehend. Thank you very much for this video. If you like it, please click on the like button, share it with your friends, subscribe to our channel, and please turn on notifications. Thank you once again. See you next time.